It's all over. Turn off the lights on your way out. The UK is officially closed for business. That's the message the Chancellor, Rishi Sunak, just sent to the world in his March 2021 budget, with the announcement that corporation tax would rise from 19% to 25%.
It's widely known that lowering the rate of corporation tax counterintuitively raises the amount of tax paid to the Treasury, as shown here. This is due to businesses being able to grow better and reinvest in themselves when they're not crippled by high taxes, and it attracts new businesses from outside the UK to come here. We absolutely agree that the pandemic needs paying for, but lowering corporation tax and encouraging growth would have been our answer to paying for the crisis. Look at that spike. What could tax receipts have risen to if the rate had been lowered further, we wonder?
Well, we'll likely never know, because the supposed expert in charge of the nation's finances must have learnt about the mathematics of tax at primary school. Tax rate goes up, more money comes in. Any 10-year-old would tell you. But it doesn't work like that.
The same flawed logic also tells you that if you set the tax rate at 100%, it would bring in 5 times as much money as the 20% tax rate, when in fact it would bring in nothing, as all businesses would shut down. Obviously, tax is not as simple as this.
In this video, we're laying out the facts about the recent tax shafting from Rishi, who's just picked the pocket of every UK citizen. We're going into depth about how bad the tax rise is, and the many ways it affects you. Let's check it out.
Welcome to Unshackled.com, the investment and finance channel and website that says you and your finance is free.
That was Andy, and I'm Ben, and if you like what we say, hit the like button and click subscribe.
Is your wallet feeling empty after these tax hikes? You can make extra money tax-free with match betting. Check out the guides and discounts on the Unshackled.com website, linked to below.
A tax cut was needed. To pay for the lockdowns, the debt, and the never-ending furlough scheme, we obviously need to increase tax receipts, but not rates. Increasing tax receipts can only be done by encouraging growth in the UK. As we've shown, a key lever to achieving this is lowering the rate of corporation tax.
This would signal to the world that our country is open for business, saying, come and invest your foreign money here. It means jobs would be created as the world's entrepreneurs set up shop in a pro-enterprise UK, and it would set the tone for global Britain post-Brexit as being pro-trade. Rishi says this raise still leaves us competitive versus the other G7 countries. He fails to realise that after Brexit, this was our chance to compete on the world stage. Forget France and Germany.
A tax cut would also allow employers to reinvest in their workforce, giving employees their much-needed pay rise. But no, Rishi chose to do the opposite, with his primary school economics leading him to think he can save the country's finances by halting growth and bleeding British companies dry. Businesses bear all the risk, all the costs, but will now receive an ever-shrinking reward.
What just happened? Worse than we imagined. In the run-up to the budget, the government had leaked to the press that a tax rise to 23% was on the cards. We reacted to the news in this video, pointing out the flaws.
But on the day, he announced 25%, which is practically what Jeremy Corbyn was proposing at the last election. He wanted 26%, which was rightly derided by the Tories at the time as being beyond the pale, as it would destroy business growth and drastically lower tax receipts. So, 26% is ludicrous, but 25% is okay.
The additional measures meant to soften the blow. The Chancellor also threw a few crumbs at businesses to make them feel like they weren't getting totally shafted. These were a tiering system for the corporation tax hike and a super deduction allowance.
The tiering system is proposed to work like this. If your business makes less than 50 grand, the 19% rate will still apply. Then the rate will gradually increase until your business makes 250 grand, at which point the full 25% rate will apply.
To this we say, who are these businesses making less than 50 grand? That's probably enough for a one-man band, practically a single household's income. Business owners with companies of this size may as well be under the self-employed tax rules and not bother being incorporated as a company at all unless they plan on growing, at which point they'll be hit by the tax rise, punished for contributing more to society.
What's more, practically every UK stock that you're ever likely to invest in, whether directly or through your pension, will make more than 250 grand, and so be taxed at the full amount. This is a tax raid on every sensible person who is saving for retirement.
As for the super deduction allowance, this is meant to incentivise companies to invest in new machinery by letting them claim back 130% of the cost as an expense against their taxes rather than the current 100%. Yeah, that's really an incentive to move to Britain. We'll tax your business to the rafters, but that machine you just bought, here's a voucher towards your next purchase.
But it's a tax on profits, not income. Stop your whining, Money Unshackled lads. Everyone knows this is just a tax on profits, and any business that dared to make a profit during the pandemic should be punished anyway. Whoa, hold up there, Guardian readers. What do you think that company profits are, if not the household incomes of pensioners and business owners?
A company can't pay tax. It's just a slip of paper in a filing cabinet after all. People pay taxes, and business profits are the lifeblood that keeps many households afloat. But this doesn't affect me. I'm an employee. Oh yeah?
A business must make a certain amount of after-tax profits in any activity or project to make it worthwhile. Therefore, some future plans will now be abandoned due to the lower return on investment. Less work means less jobs, plus less tax receipts. After-tax profitability could be restored, however, by cutting costs. The first cost to be cut in any time of shortage is the headcount. Don't expect any pay rises for the next few years.
It has effectively doubled dividend tax. Many UK investors will hold UK dividend stocks in their portfolios.
This corporation tax hike can be seen as a doubling of dividend tax by the back door. Let's look at how this might work for a British company that passes all of its profits onto shareholders in dividends.
Right now, if a company makes £100 profit for every shareholder, it pays £19 of it in corporation tax and pays you the £81 left over. So you'd receive £81, and if you're a basic rate taxpayer, pay 7.5% dividend tax, £6, leaving you with £75.
Rishi wants the following to happen instead. He wants the same company to now pay £25 in corporation tax. The £75 left over is passed on to you in dividends, and you pay 7.5% on it. Again, the best part of £6, leaving you with 69 quid. You've gone from receiving £81 and paying £6 dividend tax to receiving just £75 after an additional £6 of corporation tax, and then still paying £6 dividend tax too. The effective tax on your dividend has doubled.
What about growth stocks? Not every company pays massive dividends. In fact, most pay barely any at all. They instead prefer to reinvest their profits to help fund business growth, which translates into your pension pot or investment account going up as share prices rise.
We all own stocks like this. Growth stocks are the cornerstone of any successful pension plan. A stock's share price is roughly based on its expected future profits. Reduce those expected future profits by an extra 6% and we can expect a large drag on the share price growth.
In our portfolios, we make a big fuss about disregarding investment funds with a fee that is even 0.1% higher than another because of the immense impact a tiny fee increase can have on a portfolio over a lifetime. We're talking a cost of £50,000 if you save £500 a month over 40 years. Think what effect an extra 6% drag from tax would have on the value of your retirement pot. We're not talking about taxing the rich here. We're talking about you being robbed of a comfortable retirement.
Tax burden increased to 1960s levels. On top of the shafting you'll be getting from the corporation tax hike, those of you who are employees will also see your pay being hit more directly because they also just raised income tax. The Conservative Party manifesto at the last election promised not to raise income tax.
And yet, they've just raised it by stealth, by freezing the personal allowance thresholds at £12,570 and £50,270 for the next 5 years. Here's a nice image of how much of your money will be funneled into the Treasury over this time frame.
The OBR said the combined tax hikes in the budget would raise the tax burden on the British public to 35% of GDP. Its highest level since the late 1960s. The IFS went even further, saying the tax burden would rise to its highest sustained level in history.
The coronavirus spend has been likened to the spend during World War II. But unlike our current politicians, governments back then rightly regarded the sums as too large to be safely taken from the population through taxation during the initial years of recovery. The UK only finished paying back its war debts to the US and Canada in 2006.
What you can do about it. Really, your options are limited. No doubt, internet-based companies without a need to be on UK soil are already looking into their options to channel business profits through pro-business countries outside of the UK government's reach.
As for investments, the UK was already falling behind countries like the US in stock market growth, and that was when we were open for international business investment with a welcoming 19% corporation tax rate.
Now that it's going up by 6% to 25%, money will sadly flow out of the UK into countries that welcome foreign investment. The UK shares a border with the Republic of Ireland, which has a corporation tax rate of 12.5%, half our own. Just think about how that will affect business decisions. Half of my SIP, my personal pension, is invested in the popular Vanguard Life Strategy 100 fund. With a 25% UK weighting, that's going to have to be addressed.
Getting the message out there. Most of us can't do much about these tax grabs right now, but half the battle is convincing the public that they've been robbed so it doesn't happen again.
The public seems to support this corporation tax hike because it's seen as free money. We hope we've done our bit to get the message out there that this government-sanctioned theft will make everybody poorer.
Question of the day: how have you been affected by the budget? Join the conversation in the comments below. Thanks for watching! On this channel we talk a lot about personal finance, investing and all things money, and if you want to see more great content, please click the subscribe button below.
This is moneyunshackled.com. See you next time.